Good morning, everyone, and welcome to today's session, the 8th Annual Capital Markets and M&A Update Series. This, I believe, is our first slide up is regarding our Cpe Credit Offerings. Today, we're offering 1.5 Cpe credits. To be eligible for those credits, you do need to answer 5 of the 7 polling questions that will appear on your screen. We will not be reading the polls today, so we can have a real good dialogue with our panelists. Please remember that the Cpe credits will be available in 7 to 10 business days. And if you have difficulties with the polling questions, please let us know in the chat. We will be affording you credits if we know you have difficulties. So we do appreciate that. And in accordance with the standards of the National Registry of CPE sponsors, Cpe credit will be granted based on a 50-minute hour. It is now my pleasure to introduce Roseanne Bump, Executive Director for the Twin Cities chapter of FEI. Welcome, Roseanne.
Yeah, thank you, Nancy. Good morning, everyone. I'm going to take just a minute to preview some upcoming events. I do want to thank everybody for being here this morning. So this is our final of our 8th Annual Capital Markets and M&A Update. It is the recent developments in Reps and Warranties Insurance, so hopefully that's what you're expecting here this morning. We do have our next event is on June 2nd, Business Ethics and Real World Violations. This is for 2 ethics CPE. So if you're looking for your ethics CPE, attend that. Please join us for our 2021 annual golf outing on June 21st. And then also we have our annual meeting on July 14th. So everyone is welcome to that. I'll pop the event URL into the chat box so that you guys can take a look and see what we have going on. It's my pleasure to introduce Joe Housman. Joe is Vice President and Producer of Haigh company, Brown & Brown. Joe?
Thank you, Roseanne. It's good to see everybody. I see a lot of familiar names from some of the other capital markets series that we've put on. So thanks for having me back. Haigh Companies is an insurance broker. I think most of the people on the call are familiar with Haigh Companies. We've been around the local market for over 20 years. And recently we've partnered with Nia and David on some reps and warranties transactions. So given the work we've spent together on M&A and reps and warranties, I thought it would be appropriate to bring them in to talk about some of our experiences, particularly with respect to recent developments, but also understanding we might need to do a little bit of reps and warranties 101. So Nia Brown is a corporate and securities attorney for DLA Piper. David Haigh is the managing director and co-founder of Atlantic Global Risk, which specializes exclusively in M&A reps and warranties products. So I'm going to invite Nia first to introduce herself and her firm, and then David after that before we jump into the content. Nia?
Hello, thank you so much, Joe. Good morning, everyone. I'm very happy to be here. I enjoy educating folks quite a bit. My background is in M&A. I was an M&A attorney for several years. And about 4 years ago, I pivoted quite a bit and began to specialize exclusively with assisting our clients, individuals and private client strategics and PEs in obtaining transactional insurance. The bulk of my work is done in advising and obtaining on rep and warranty insurance, which is the focus of this presentation. So I'm very happy to be here. Most of you, I hope, know about DLA Piper. I know that we'll be circulating a slide deck later on that will include some notes about the firm. But just for those of you who don't know, we are a full service corporate firm that is international with over 4,000 attorneys in 40 different countries. And we're well positioned to help with any legal needs that you need anywhere in the world. And I'll keep it short and sweet. And with that, pass it over to David.
Thanks, Nia. Hi, everyone. Thank you very much for having me on today. Great speaking with you. As Joe mentioned, I'm David Haigh, co-founder and managing director of Atlantic Global Risk. Atlantic Global Risk is a specialist insurance broker, and we only focus on transactional risk insurance products. So that's things like rep and warranty insurance, and then some of the other transactional insurance products that we'll talk about today. I've spent my entire kind of career pretty much as an insurance broker supporting clients in the kind of negotiation and placement of these insurance policies to support M&A transactions. That covers all sorts of sectors, all sorts of sizes. And yeah, very happy to be here today to talk to you all about rep and warranty insurance.
All right, thanks, David. And just to close the loop for everybody in terms of how we work together, we'll talk about it in the presentation more, but David said, he focuses exclusively on reps and warranties insurance from an insurance brokerage standpoint. Haigh companies and my team focuses a lot more on the insurance due diligence. So, going in and doing diligence on what the current portfolio company looks like so that the reps and warranties carriers have some comfort that the underlying programs are in place. So we'll get into that in a little bit more detail, but wanted to close the loop on that. I think it's up to me to share my screen. Let's see if we can figure this out without too much. And then I need to present. All right. Roseanne, did I do that okay? Is that looking good?
Perfect.
Looks perfect. Mhm.
David's laughing at me because I had some technical difficulties as we were getting set up. So we're off on the right foot. Brief agenda for today. As I mentioned, we're going to do a little bit of an overview. In fact, I think that's going to be a good part of this session. I think there's probably some people that haven't worked with reps and warranties, so it'll be educational. And then towards the back half of the meeting, we're going to get into the, I guess the meat of the conversation in terms of what claims we've dealt with and a little bit more what's going on lately with the current market. So that brings us to the first polling question, which should have popped up on your screen. We want to get a little bit of a feel about who we're working with. So how many times have you worked with Reps and Warranties Insurance? More than 10 times, 3 to 10, once or twice, or never. I'll give you guys another 10 seconds or so to respond to this question before we move forward. I suppose I should respond as well. Okay, so as I suspected, we're a little bit across the board. We got a couple people. I suspect maybe the presenters have done it 10 plus times. A few people in that 3 to 10. Was that? Did you answer too, Nia?
I did.
All right. All right. We just gave ourselves a brief bio about each of the presenters and our respective firms, but we know this is going to be a deck that gets distributed. So we do have biographies and background for each of us, including contact information if you have any questions or opportunities for us to advise on. This deck will be going out after the call. Touched on a little bit about each of our companies. This particular slide is one we may come back to later in the conversation. David mentioned they focus exclusively on transactional insurance. So we're talking about reps and warranties today, but there's a lot of other products that spin off of that from a transactional standpoint. We may get into some of those. And DLA Piper. All right, polling question number 2. What industry is your business in? So again, when it comes to insurance and risk management, a tech company is a lot different than a healthcare, is a lot different than a manufacturer, is a lot different than on and on and on. We want to get a little bit of a feel about what industries you guys are in case that helps tailor the conversation a little bit. Give you another 5 or 6 seconds or so. All right, let's see the results. Interesting. Okay, well, tech and healthcare with no responses. So manufacturing, business services, and then other. So again, a pretty wide representation. All right. For the overview, Nia, I think you were going to talk first about what the recent trend looks like. Where did reps and warranties come from? And where are we at now in terms of deal flow?
Yeah, I do want to just pivot just a little bit, Joe, and that polling question was actually really helpful because I got a sense of sort of the population of folks who are in the audience and what we're listening to, what you're sort of listening to us talk about. And we keep throwing it around these terms, and I just want to make sure that everyone perfectly, understands what rep and warranty is versus, sort of all of the transactional products insurance that we can get. And so the focus of this particular slide was mostly to give you guys a sense of sort of the significant growth in not only North America, but also in Europe during the past decade or so in terms of how this product has been used essentially. So there are, well over now, and I think this is as of 2019, I've seen something even more recent to suggest, although not final, that number of rep and warranty deals is sort of closer to even 12,000 for 2020. That's not in the deck because we can't confirm it, and we'll get into all this a little bit later on, but there are over 20 or so underwriters in the market right now. And my firm alone, in my personal experience, I've handled close to 500 deals since I started to go into this space in the last 12 or 14 months only. So we're currently active in all aspects of obtaining transactional insurance solutions, from the initial concept to negotiation and placement. And so the basic premise of what rep and warranty insurance is, it covers, it shifts risk, right? So essentially what they're going to say is, under a traditional structure, you have to look to the sellers, you have to have an escrow, you tie up funds. But what I've seen, and why I believe that it has grown so exponentially, and it's a ubiquitous product now. I think almost every deal that I've touched, like I said, in the last 12 to 14 months has involved rep and warranty insurance, or one of our clients has asked for sort of a primer on what is rep and warranty insurance. So it's true to state that the acceptance and use of the product has increased dramatically over the last 10 years or so. It was originally used primarily by most of our PE clients, and it was once a very select product that only certain folks in one type of space would use. But again, we have seen it explode, and strategic buyers have been using it. It offers sellers a limited or no indemnity deal structure. Our clients tell us how because it facilitates such clean exits and avoids, the typical holdbacks and escrows, that as a product in terms of touching M&A deals, private equity deals, venture deals, it's taken off. I mean, I've used it recently in carve-outs, spins, SPAC deals, distressed deals. It's become a flexible product that can be used in a variety of ways in order to facilitate smooth execution on M&A deals.
Hey, Nia, one thing I want to touch on is, you hit on it a little bit. It started off, it was almost exclusively private equity.
Yeah.
Over my last 12 to 18 months, I've worked with a lot of Fortune 500 strategic buyers, and I always pose that question to them: what's your appetite for reps and warranty? And a lot of them, we're dealing again with bigger companies, so their risk appetite is a lot more self-insurance, where they're going to retain the risk. And they do the same thing with M&A deals, but they've made the comment it's seller driven. The market has matured so much that sellers actually are putting it in their sim. They're putting it in whatever their placement deck is, and they're making it kind of table stakes as part of the transaction. So then, instead of having it as a differentiator at the table, 10 years ago, now it's almost like you got to have it or be prepared to work with it. Do you find that in your practice as well?
I do. And not only is it seller driven, especially, and I'm glad that you brought that up, because I can tell you again, I know I keep going back to the last 12 to 14 months, but I think that it's really telling because of the fact that this product has continued to be used so ubiquitously in deals even throughout this pandemic, right? And there was a time when, and I'll let David speak to this a lot more in depth because it probably predates my entrance into this particular market, but there was a time when only a PE firm would be doing the deal, and only with a deal. The course of the last 3 years, I can tell you that I insured a deal last week for $10 million. So the use of this product with smaller deals, public style deals, no seller indemnity deals. I've done real estate deals actually that, you know, you typically wouldn't see this product used in that market or in that space. But just to go to show you just how this has exploded on the scene, you're getting the use of the product on deal size that varies, deal participants that varies. And oftentimes, like Joe was saying, it used to be something that made you more attractive in an auction or a competitive process. Now you can't even get a deal done. You won't even be considered if you don't really show that you've done some exploring into what and how you can utilize the product.
All right, David, any comments, or should we jump to the next slide?
No, I completely agree with Nia. I mean, obviously, this product has really taken off in the last couple of years, and to your point, it's really been driven by the fact that we've been operating in a seller's market for a long time, and sellers have been able to drive deal terms and have been able to force buyers' hands into using this product. And I think with the continued use of this product by lots of people, attorneys like Nia and other people who are buying more and more businesses, the knowledge of this product is just spreading across the US, and people are seeing the benefits that it brings to transactions that we're going to talk about a bit later.
I would like to jump in if I could. I'm sorry, I don't mean to interrupt you, David, but one of the things that I think is also worth noting is that the majority of the policies in the market today, although it's a seller-driven product in terms of use, the majority of the policies that are currently in the market are buy-side policies. So although as a product, it can be used on both sides because it enhances the indemnification package for both seller and buyer in certain prospects. And of course, I don't mean to step on David's toes. He's going to get to that in the next slide. But it does protect against losses that results from inaccuracies in the reps and warranties that relate to the target and sellers, but it can be purchased as a product on both buy and sell side. But this particular presentation is going to focus primarily on buy side policies.
All right.
So shall
David,
why don't we talk about a bit more about what rep and warranty insurance actually is in its kind of most basic form, and importantly for you all out there, particularly if you're contemplating buying a business or selling a business, what does it actually protect the buyer for, and is it the same as the protections that you would get under a typical purchase agreement, and if not, what are the differences? And so to kind of recap, we're talking about rep and warranty insurance here. We're talking about it being held by a buyer. That means that a buyer can bring a claim against an A-rated insurance company for the loss that it suffers as a result of a breach of a rep given by a seller or a company in a purchase agreement. And so at its basic level, that's what we're talking about. It doesn't have to involve the seller. The buyer can turn directly to the insurance company and recover the financial loss that it's suffered as a result of that breach. What is a rep or a warranty? Well, very simply, sellers use reps and warranties and buyers use reps and warranties in transaction documents to obtain information about companies, i.e. illicit disclosure. So a rep and a warranty, very simply, it's a statement of fact about a company at a particular given point in time. That point in time is typically signing, is oftentimes restated at closing. And reps and warranties are primarily used to, as I say, elicit disclosure. And that's because for those statements those statements have to be true. And as a result, a seller has to tell you all of the exceptions to the statements that you negotiate with them as a buyer. So you've got a contract that contains all of these statements, and appended to the contract, you've got what are called disclosure schedules, which set out all of the exceptions to those statements. And the disclosure that this forces the seller to give you is used by the buyer to diligence the company and to accurately value the company prior to you agreeing to buy it. So that's the first kind of mechanism of reps and warranties in contracts. But the second mechanism, which is what we're here for, is they give you a post-closing remedy to recover the damages that you suffer if, in fact, one of those statements turns out not to be true. So at the time you bought the business, you weren't aware of a breach, but in the time period after you've bought the business, you discover that one of those reps and warranties is not, in fact, true. Good example of a very standard or typical rep. It could be, hey, the company's not subject to any litigation. It could be that the seller owns the shares to the company. It could be that the company's paid all of its taxes. Its financial statements have been prepared in accordance with GAAP and fairly present in all material respects the financial condition of the company, et cetera, et cetera. So there's a huge kind of breadth of topics which these reps and warranties can speak to, and it's ultimately the job of a broker, on my part at least, to convince an insurance company to cover all of the reps given by a seller or the company in a purchase agreement, and that way we get as much protection for the buyer as possible. And in an ideal world, they cover every single rep and warranty that the seller gives and that the buyer negotiates. And if they do, then you've got a fantastic insurance product on your hands. In addition to reps and warranties, for those of you that have seen a lot of purchase agreements, you'll know that there's a pre-closing tax indemnity often given by sellers. And that will be an indemnity that kind of indemnifies the buyer against any pre-closing taxes. So notwithstanding the fact that they might not be subject to the reps and warranties, it's just period. If there are any pre-closing taxes that hit the company after the date of closing, the seller, or in our instance, the insurer, will indemnify you for those pre-closing taxes. So that's what we're trying to cover. There are obviously other things in purchase agreements like covenants and other areas of very specific indemnification where you might be able to seek recourse from a seller if something's not quite right. A good example might be a purchase price adjustment or a net working capital adjustment. That's not what we're trying to cover. The scope of the cover really here is a breach of a rep that you didn't know about and a claim for pre-closing taxes that, again, you didn't know about. And so there's a bit of a difference there between the indemnity that's covered by insurance and the indemnity that's given by a seller. So known matters are out, purchase price adjustments are out. And then as you can see on the right-hand side, we've got exclusions. And these are the things that in an insurance policy aren't covered by the insurance. And these are ones that are not really negotiable. These are typical universal exclusions that you can expect on pretty much every deal you do with rep and warranty insurance. And for the most part, you may be able to bring a claim for a seller absent the use of rep and warranty insurance, i.e. there's not going to be an exclusion in a purchase agreement for claims that relate to transfer pricing, but with a rep and warranty policy, there is. So these are all of the types of issues that you are not going to get covered for in rep and warranty insurance.
So David, I got a question. For you,
Go.
just to make a practical application of it. So in due diligence, you touch on known versus unknown issues, right? S corp status, wage and hour laws. There's a whole bunch of diligence matters that pop up that are gray areas. This could be an issue, maybe it's not. And so I've seen examples of where, before reps and warranties, the simple answer was, well, just throw an indemnity into the agreement and the seller is going to wear that risk. Now with reps and warranties and a third party, it's not that simple. So can you maybe speak to what that looks like? How does the carrier, throw the issue out there? And then how does the deal team respond? And, pick an example.
Absolutely. Yeah. So I think that's a great point. Is kind of, I suppose your question is also, how do insurers get comfortable stepping into the shoes of sellers? And really what they're doing is they're not sector specific experts. They're not, doing their own due diligence. They're really sitting with the buyer and analyzing the process. They're looking at how a seller approaches the scheduling exercise that I talked about, how it engages in the negotiation of the reps and warranties, how it populates a data room and discloses all of the documents that a buyer might need to prudently diligence and analyze a business. And they're then looking to the buyer to conduct due diligence. And that due diligence is independent of the insurance company. It might be done by lawyers like Nia, or it might be done by tax professionals or CPAs from a kind of quality of earnings or financial due diligence standpoint. And they're taking all of the work that the buyer is doing to accurately value the business today, and they're looking through it to get a feeling for, hey, do I want to step into the shoes of the seller in each of the reps and warranties? A really common example, looks like we've got manufacturing folks in the audience. A good example would be, okay, why would I want to step into the shoes of, as Joe said before, compliance with wage and hour labor laws? How do we know that the company has been appropriately classifying its employees? And to the extent it has, how do we know that it's been paying them correctly? Let's say you've got a lot of, non-exempt workers that are, non-exempts from the Fair Labor Standards Act. They're eligible for overtime. How do we know they've been paid the right amount of overtime? How do we know that their hours have been tracked appropriately? And how do we know that we're not going to face a huge liability after buying the company with claims or class action lawsuits from all of our employees? So the buyer will conduct legal due diligence on that point, and they'll present those findings to the insurers. And to the extent there's a gray area, then there's going to be a negotiation. And that negotiation is going to be where the insurer tries to exclude an issue, and the buyer is fighting for coverage. And it's our job to collectively all work together, including Joe, including Nia, including myself, on any given deal and fight for our clients, advocate for them to make sure that they get the coverage. If an issue is really truly known, and what do we mean by that? Well, that we actually know today that there is a breach and that statement in the purchase agreement isn't true, then the chances are there's going to be a specific exclusion that's going to read out, okay, we think X employee is misclassified or hasn't been paid the right amount of money. And hopefully those exclusions are as limited as possible, but it's our job to negotiate those.
Great, thanks. We jump to the next slide. All right, I think this is still David, and you may have touched on some of this.
Yeah, so I think we've touched on some of it, but I think it's important, right? Why would you use rep and warranty insurance? Why would you choose an insurer as your kind of counterparty for post-closing breaches of reps and warranties for that indemnification? Why would you choose an insurer for that? What benefits does it bring to the deal? Well, let's split it up between buyer and seller, because these products and in particular rep and warranty insurance does benefit both parties. Everybody's aligned from an interest standpoint in the fact that a good insurance policy benefits the buyer because they've got robust protection, but the more robust protection the buyer has, the cleaner break the seller has. So everybody's incentivized to get a very good insurance policy that everybody's happy with. Well, what can a seller do with rep and warranty insurance? Well, the primary driver for using rep and warranty insurance is to give the seller a clean break and allow them to walk away from a deal and sleep at night knowing that a buyer is not going to come out of left field and bring a claim for a breach of a rep and warranty. That gives them certainty over proceeds, and that allows them to utilize that money immediately after the sale of a business or assets. I think it's how do they actually do that? Well, generally what happens is in a purchase agreement, the seller will limit its liability contractually. It will still give the reps, it will still disclose against them, but their financial liability in the event of a breach will be limited. And what happens, why do buyers accept that? Well, buyers accept that because they've got a separate standalone contract with an insurance company that says, hey, if there is a breach in this other document, we will indemnify you on these terms. And so the policy sits independent from the purchase agreement, but utilizes a lot of the provisions within the purchase agreement. And the buyer can bring a claim directly against an insurer. So the seller contractually limits its liability. The buyer gets its protection from an insurance policy. And because of that, as you can probably see, the negotiations between the parties get a lot easier. You're not arguing over survival periods. You're not arguing over caps and baskets. You're not arguing really over the scope of the reps, because as a seller, provided that you can go through a scheduling exercise and you're happy to do that, there isn't really an impact on the deal by you giving more reps and allowing the buyer to get the protection that it needs from an insurance policy. So because you make the indemnification independent of the purchase agreement, you ease the negotiations. There's less time, you can execute more quickly, and you're not wasting money arguing over, caps, baskets, survival periods that can be dealt with independently in a policy. You utilize the contract to give the seller the clean exit. And by doing that, you avoid escrows. You can utilize the proceeds after the fact, which if you're a private equity sponsor, mean that you can boost IRR and get your proceeds back to your LPs quicker. If you're a strategic, you can then deploy that capital elsewhere and go and buy further businesses or utilize that money in a way that you see fit. So main benefits from the seller is its ability to walk away from a deal without any concern over post-closing liability. For a buyer, they can use it as a tool to differentiate a bid, to set themselves apart in an auction process and say, you know what, we're going to give you a favorable deal, seller, but don't worry, I'm simultaneously going to get the protection that I need from an insurance company. One of the biggest drivers that we see in the deals that we do is, in fact, oftentimes you're investing in people, you're investing in management teams, you're investing in founders, and as part of the negotiation process, you want them to stay with the business, you want them to help you to continue to grow and realize more value. And so they stick around. They stick around through employment contracts, they stick around through rollover equity. And after the fact, do you really want to be bringing a claim against the people who you've invested in? Probably not. So having this kind of faceless insurer that you can bring a claim against allows you to preserve relationships with the key people that you've invested in to run your business. And then finally, as I mentioned, the indemnification is separate, it's standalone, it's in a different document from the purchase agreement itself. It's synthetics and it's offered by an insurance company that's A-rated. So from a counterparty risk standpoint, the reason that we all negotiate escrows is because we're worried that after the fact, will the seller be good for the money? Well, here, you're not worried about that. The beauty of insurance is it's this unfunded guarantee of creditworthiness, and all of the insurers that we work with, every insurer that participates in this market is rated, investment grade and is A-rated. So no concerns over creditworthiness either.
Quick question for you, David. So first of all, if you have questions for the group, feel free to put them in the chat. I just threw that into the chat function. I heard what you said in this slide. The buyer is typically the one that's going to be the insured. They're the one taking out the policy, right? Because the seller is the one that makes the representations. Practically speaking, I've seen it across the board in terms of who pays for it. Would you agree with that?
Yeah, I think my view is that the seller always pays for it. It might not be coming directly out of their pocket, i.e. it might not be the seller paying for the invoice of the premium, but ultimately this is going to be considered as a transaction expense and taken off the headline enterprise value or purchase price. So for me, indirectly, the seller always pays for it. If you're in a competitive process, a buyer will certainly want to be the one picking up the tab or being seen to pick up the tab. If a seller's got not a lot of leverage and maybe is coming to the end of a fund life or can't give the meaningful protections that a buyer would want, then the seller might be inclined to pay for a portion of the proceeds, so of the premium. So it's a real mixed bag. We see it split in lots and lots of different ways. And it largely depends on the kind of negotiation dynamics of a given deal. But in my view, sellers always pay for it directly or indirectly.
And from my perspective, advising my clients on the M&A side of things, typically the buyers here, what we try to do is this is where you can be a little bit more creative, right, Joe? So especially to David's point, if it's an auction transaction, we might say to a seller, can you at least be on the hook for a portion of the deductible or the retention under the policy? We'll pay for all of the taxes and underwriting fees, etc. But we would expect you seller can at least go half with us on the premium. So while I think that there has been sort of a shift over the course of several years as to how this really gets paid out, I would agree with David that on sort of the face of things, the seller is really coming out of pocket, whether that's truly out of pocket or as a transaction expense. But from the way that we typically try to advise when I'm on the buyer side is we want to be a little bit more creative, right? Because we're trying to be as attractive to them. But again, when it's a fully seller driven requirement that in order to even play or to present yourself at, in this bid process, we will say, seller, you're on the hook for everything. And I think it's also important to point out, although I do think we have a slide later, that the cost of a rep and warranty policy it's not just the premium. It's the premium cost, underwriting fees, surplus lines tax. To a certain extent, many brokers charge an additional fee on top of or like what we consider a placement fee or a commission. So, all of that together constitutes the exact amount that needs to be paid with the policy.
Well, and that's good perspective. And that's exactly why I asked the question, was because I've seen instances where it's an auction and that's in the document that goes out. So everybody knows it's part of the process, and it feels like then the buyer is going to be more responsible for it. I've also seen instances where large deals, they're going down the path with just two parties that are exclusive. And then all of a sudden, late in the process, they say, oh yeah, we're going to do reps and warranties. And then the other party says, no, we want our sellers to stand behind their reps. And so we always plan to have an escrow. And so then it becomes another negotiating thing and a long list of things that need to be negotiated, as you can imagine, in any deal.
I would say, and David can weigh in here, I would say if it is a true public style, no seller indemnity deal where a seller has 100% walkaway rights and really no post-closing indemnification obligations, that's when, from a buyer perspective, we're able to get them to pay for at least a portion of the policy, because they really are getting true, we're just walking away from this, and you're going to rely exclusively on the insurer.
All right, I think we have one more kind of overview background slide. I think we could probably get through this one pretty quick before we get into some more of the recent developments that we're seeing in the marketplace. David, I think we're going to have you walk through this.
Okay, perfect. So yeah, I think fairly simple process of obtaining buy-side rep and warranty insurance, and it kind of tracks along with your other due diligence work streams, including your legal, your financial, your tax, or environmental, etc. And it's really done in the kind of, I would say, the final 3 weeks up and until signing or of the purchase agreement. And I would say for most transactions, the policies incept immediately after you have executed the transaction documents, so it's signing. Sometimes it's put in place at closing, sometimes there's a delay for whatever reason that means that you don't deal with the insurance until the interim period.
At signing.
So yeah, it's always, it's vast majority of it times it's at signing, sometimes it's at closing, but we always advise our clients to get the policy put in place at signing. And so you're really dealing with this work stream in the kind of the 3 weeks prior to signing. And what is the process of obtaining insurance? It's really split into 3 different parts of the process. So the first is kind of familiarizing ourselves, all the people on this call, understanding kind of what the business does, how it makes money, where the perceived kind of legacy risks are, those risks that the insurers might care about. So with a manufacturing business, that could be anything from, we mentioned wage and hour labor laws before, it could be product liability, it could be environmental risk. These are things that could really give rise to a breach. So sleeping dogs that are out there that we don't know about when we transact the business today, but we find out about in the future. And that's the first stage for getting terms from insurance policies, from insurers. And for us as insurance brokers, I mean, we do this the whole time. We advise on a significant number of transactions with fairly high level information. We can give you a rough estimate for what the costs and the pricing, the parameters of an insurance policy might look like. We can do that very quickly. But if you want formal pricing from the 20 to 25 insurers in the market, then we need to start negotiating terms. And that generally takes us a kind of about a week to put a report together. where we'll go out and we'll speak with all of the insurers in the market, and we'll get their feedback, get their pricing, get the terms. We'll talk to them about their exclusions, and we'll put a report together for the buyer to review. And what does that need? It needs generally a copy of the purchase agreement, a copy of the company's financial statements. We at Atlantic like to get access to the data room and review a lot more documents than that, but at its most basic level, the purchase agreement, the financial statements, and if this is a kind of widely marketed company, then the chances are there's some form of confidential investment memorandum or SIM that we can use to familiarize ourselves with the nature of the company. Of course, we can use publicly available information like the websites, and really we're taking all of that information and putting together a report for the insurance market to say, hey, this is the transaction that's occurring. This is the company that's being bought. This is where we perceive the key exposures to be. And this is the purchase agreement. Here are some of the key provisions and key terms that we think you'll care about. And we'll use that to inform our negotiations and negotiate this report that I talked to you about, where we'll summarize the feedback from all of the different insurers in the market. And that doesn't cost anything. It's, as I said, usually a week-long exercise, but it needs access to the data room generally. It needs the company's financial statements, and importantly, it needs the purchase agreement. So we need to be able to see the reps and warranties. So we can't really get involved until a purchase agreement is available. In that report, we'll set out a recommendation generally that will say, hey, we think that this insurer is the best, the best person for this underwriter is the best person for the job. And rep and warranty insurance is more involved than, or at least the underwriting is a lot more involved than other insurance policies, in the sense that you then have to spend this next phase, this underwriting phase, where an insurance company requires a financial commitment and an underwriting fee that it uses to pay its counsel to really consider the deal in depth. And for them to do that, they want to see due diligence reports, typically across legal, financial, and tax as a minimum. So that's quality of earnings report. It's a typical legal due diligence report analyzing the kind of key legal issues in connection with acquiring the company, and then a tax report looking at the past 3 years tax returns and considering some of the potential state, local, and federal tax exposures that the company might have. So we're using those reports, as I mentioned earlier. The insurance companies are using those to step into the shoes of the seller and take on these reps and warranties, and the buyer, along with Nia, Joe and I will all be together negotiating with the insurance company, convincing them that they should stand behind all of the reps and warranties. As part of the underwriting process, there's a conference call called an underwriting call. All parties call with all advisors, including everybody that's conducted due diligence, including us as the insurance broker, and the insurer and their advisors. And they'll fire a lot of questions at you and your advisors about the findings in the report, the due diligence, the process that you've been through, really with a view to understanding a bit more of the context and the narrative behind the reports that you have prepared. And with all of that information, they'll put together a first draft policy, which Nia, myself, and Joe and others will negotiate, and we'll try and get it to a point where it's ready to go immediately after the signing of the purchase agreement, and then the policy will incept. So you've got these 3 phases. I would say, generally speaking, it takes a kind of 3-week process. It can go quicker, it can go slower. We tend to track the deal, and it's split up into these 3 different phases. Nia, is there anything to add that I might have missed from a process standpoint that's important?
No, I don't think that you've missed anything. I will say just to this group, in terms of the purpose of my role at the firm internally, is to sort of help our clients get guidance with that first step. So before, the Davids and the other brokers are brought in to go out to take a deal, we call it taking the deal to market. And that's to David's point about going out to those 20 to 25 or however handful of insurers that are probably best suited to given the market space. and how robust the deal is, how large the deal is. This is where it's very helpful to have a very experienced broker who knows where to take this deal, right? Because this is not, every deal is not necessarily going to be attractive, or not every insurer has an appetite to do each and every deal. So my role is at that sort of initial diligence stage. And what I try to do there is to make sure that our clients, along with their other third-party advisors, have all of the necessary diligence type of things that an insurer would expect usually need to be done in order for David to take it to the market, right? And so to the extent that he takes it to the market and we get good, robust NBILs, or what we call quotes from the insurers, we have to be fairly quickly thereafter, we have to provide those diligence reports. So a lot of sort of the forerunning stuff that needs to be done is, that's where you have to do the right level of diligence. And I think we're going to get into that in the next slide. So I don't know if Joe, you had a question before moving on to that.
Well, I think that's a good segue into the diligence area.
Yeah, perfect. So what you need to keep in mind is that these insurers are not going to go out and do any independent diligence, right? So at the quote stage, we give them enough information so that they understand who the target is. We give them the SIM if that's available. To David's point, we try to break down exactly what we view the deal terms to be. And what they're producing, or what the insurers are giving you, is just a quote. It's what they're sort of saying, okay, we're going to look at the market, we're going to look at the target, we're going to look at the strength of the diligence that you've conducted, whether or not you've highlighted any areas of particular risk in any of your own reports or not. And to the extent that you have, we're going to upfront, we call them sort of upfront deal specific exclusions. So I think that in terms of what you should be thinking of, or given that this group that we have on the line, you guys are in a lot of different areas. But what I tend to tell my clients is, and a lot of the third-party advisors who are going to be providing a diligence deliverable, is that we want to give the insurer the impression, accurately, that we've done a robust diligence exercise that we would have done outside of any insurance. Rep and warranty insurance being done, right? So we want to make sure that we let them know that we've had ongoing communications with the seller, that we've been in contact with them, they've been responsive. We believe that the disclosures are adequate given, our knowledge of it. And so the thing that you want to be ever mindful of is that you have to produce those reports. If there's a written formal report done in respect of diligence, that report needs to be provided to the insurer. And at the signing and closing, as David was mentioning, you have to certify that you have now provided everything. So I come from a standpoint, usually when I'm advising clients, of what not to put in those reports, right? That this is going to end up in the hands of the insurer. And so in that context, over the years, we've tried to explain that it's very important to be specific in what you've identified. You don't have to look under every stone and focus on you have to focus on what's reasonable for the deal size and for the market. We tend to tell people to shy away from adjectives unless they're very, very precise. So in reports, you don't want to say things like, this is a red flag, this is unreasonable, this is materially, bad, run for the hills, because these are going to be areas that an insurer will focus on. And to that point, very specifically, at the quote stage, what we've talked about is there's this concept of they give us in the quote stage an idea of where their focus is going to be. And so this list here on this slide, you'll see these bullet pointed areas are sort of your standard or your typical areas of underwriter focus in the market today. If there's going to be wage and hour, if there's a pre-closing reorganization or restructuring, this is where they're going to look, right? Anything, if the target business is heavily in the cyberspace or products liability, malpractice, environmental, you should expect offhand that that's going to be an area where insurers are going to want to see that you've done a robust diligence, and that they may tell you in their quote stage, these are the areas that we're going to highlight. These are the areas that we're going to particularly scrutinize when we get on that underwriting call that David was talking about. One thing I also want to say is one of the most important views is the materiality threshold. So now insurers have what is called sort of the retention is based off of what you're going to be, the deductible, for lack of a better word, it's the deductible. And so the view of materiality is what that deductible is. We've typically seen the market stay around 1% of the enterprise value, but it varies depending on, again, the size of the deal. So if you have a 1% aggregate retention, like I said, every stone doesn't need to be turned over and examined for preciseness, but that would be off market. But what is expected is an insurer is going to expect that anything that has a risk that gets into the sort of high fives, definitely six figures, typically depending on, again, the size of the deal, you know, that's going to be what's going to be focused on. And so as you're, you know, negotiating and as you're thinking about what coverage looks like, it's important to keep in mind those areas that, you know, where is it material? What have the insurers already highlighted in their quotes that they want to focus on, and what that looks like. You know, I think it goes without saying in this day and age that we live in, that loss resulting from COVID or CARES Act or PPP loan forgiveness, those are they're typically excluded, although many insurers will take a broader approach. But that's another area that's not necessarily highlighted here, where some insurers will take a more tailored approach and exclude only risks that were identified during diligence. So we've been successful as of late in sort of narrowing the really specified or identified risk, and in many areas, you know, getting insurers comfortable with the diligence that we've uncovered to say, you know, there's no reason that you need that third stage that David was talking about. You know, once we've had the call and they've seen all of our diligence and we've discussed with them where we think there may be some risk, that's where we'll sort of go back and forth with them. And I'm sorry, I apologize. I got dropped a little bit earlier from the call, but I just wanted to point out that as David mentioned, any issue that's known to a deal team member to be a breach of a rep and warranty, whether it's disclosed or not. So meaning if it's considered known if it's in one of those reports, right? So whether it's actually on the disclosure schedule or not, if it's in a report, an insurer is going to take a position that this is a known risk, and it will generally not be covered. But there are risks, and there are certain matters that might not be known to be actual present breaches, and those are where you might want to discuss it. I'm sorry, you might want to negotiate further sort of why the risk is not material.
Sorry, I saw a chat pop up about discussing claim payments. And so Mark, thank you for that question. We are going to get into claims in about 3 or 4 slides. So why don't we hold that question, and then if we don't address it, I'll make sure we can address it at that point. So you started to talk a little bit about you know, some of the more specific items that are diligenced, and so I'll put a quick word in here that from an insurance due diligence standpoint, right? David does the Reps Warranties Insurance. Haigh, we will come in and we'll do a full dive on everything, and that's part of our services, right? We would do that alongside the tax, the Q of E, the environmental, whatever other issues there are. And as I look at this list, you know, you're not listing things like auto or workers' comp or general liability. You know, those are typically issues we will look at and make sure there's adequate coverage on. But as I look at cybersecurity, you know, if there's a claim on cybersecurity, that's a one-time big event, right? It's not like auto where you've got a big fleet and the risk churns, or workers' comp where you know you're going to have workers' comp and that risk kind of churns on a regular basis. So I guess my point here is these are mostly claims made, more targeted risks. And I think that goes to the next slide, which is the heightened, you know, focus on underwriting. So I'm going to try and get there. So when you think about this, I think it's a good segue. As I'm doing my diligence, the reps and warranties carriers are sitting there saying, I'm going to sit excess, no broader, which really means Joe's going to do diligence. We want to understand exactly what that insurance is, because if there's a claim that would be a reps and warranties claim, we want to make sure there's a policy in place that's going to respond. So Maybe I'll hand it off to you at this point to talk about this slide and what that excess and no broader concept is.
Thank you. So the idea here, and I'll try to speak quickly. I know we're running low on time, but there's a decreasing appetite of certain insurers in this space to really jump into fully covering things, like to the extent that Joe said. Usually this is in the cyberspace, products liability, environmental, E&O. This sort of piggybacks on the prior slide about being heightened areas of risk, right? And if there's a loss under a rep and warranty policy, insurers want to make sure and understand whether or not that loss can somehow be mitigated and not have to pay it all out of the rep and warranty policy, right? Because some things are very specific to certain areas. Again, the list is there. So what rep and warranty policies used to contain, and this is years ago, is there was a very broad upfront exclusion. They're just not going to cover anything. Now, over the course of the last several years, or much more recent years, they have this concept of covering certain subject matter, but the caveat is that they will only cover it to the extent that the loss is excess of, and you'll see it in two words. You'll see sometimes it just says excess of, and sometimes you'll see excess and no broader than whatever the underlying insurance policies limits are. And it's not every type of underlying insurance that there's this hyper focused risk on. It's typically products. It's limited, obviously, for reasons that no need to explain. Cyber, data security. These are areas where it's difficult to evaluate exactly what that coverage could look like. And so insurers want to make sure that we have done diligence to the extent that we can. And this is where folks like Joe come in so handily. I can't tell you, I wish he was on every deal for me. Because what they're going to say is, we will cover it, but we're only going to cover it once you've exhausted all of the limits under any other valid, available, and applicable insurance policy that would otherwise speak to this without it being a breach of a rep under the current deal. It also usually states that there is going to be, any loss is going to be offset by those recoveries in a way such that we're going to follow or mimic the terms that are set forth in that underlying policy. So whatever exclusions were in that policy that you wouldn't be able to look to it for a certain type of breach, then we, the rep and warranty insurance carrier, will follow that. That's sort of what the no broader than part of that sounds like. Now, all insurers are not equal in their position. I'd like to put that there specifically because it's still diligence dependent. The market is tougher now than ever before. So some insurers are much more conservative when it comes to this language. Some insurers will put it in their quote right up front. And that's something that David's report and that I work very closely with my clients to make sure that I highlight early on, that the selection of the insurer, this is one of those areas where you want to make sure that you understand that insurer's position before you start down the trail of having to negotiate a policy and deal with this or not.
All right, I think we have one final slide before we get back to some polling questions and get into some discussion about claims.
Yeah, I can go really quickly. I think I should be able to move quickly through this. So this slide is meant to sort of give you a sense of what a policy structure currently looks like. And you'll note that it's a little bit different from a traditional deal because the insurer is assuming the deal risk that would otherwise fall on a buyer or a seller. So in a traditional transaction, you'll see that there's usually a seller's cap on risk that's done via an escrow or a holdback that's held for, let's call it, 12 to 18 months. And there's, also a buyer deductible on top of that traditional structure. But here you'll see, and what this middle graphic is showing is that there's lower cost coverage that can be available for certain identified risk, but the policy limit, and we're going to say it's typically around 10% of the enterprise value, once you get past that retention, which, as we talked about earlier, nowadays is typically split, but sometimes it's just all buyer risk. Once you get past that retention, the policy will kick in and you'll have immediate recovery, which is obviously a lot different from, you know, sort of the traditional structure where you have to rely on going to the holdback, and then you have to go back and forth with the seller as to whether or not they're going to actually cover it or if it's applicable. So this is really just the sort of standard terms of any deal nowadays. You're going to get coverage for fundamental reps, and we call the fundamentals sort of those typical authority, capitalization, subsidiaries, sometimes non-contravention, but not always. But, you know, a no brokers rep, those are sort of the very customary typical reps that will get coverage under the policy for 6 years. Also, oftentimes a tax rep will be included as fundamental, but to David's point earlier, pre-closing tax indemnity, whether it's provided for in a purchase agreement or not, you'll see that sometimes referred to as a synthetic pre-closing tax indemnity. That also has a 6-year coverage period. And then the rest of your general reps are, you know, the 3 years. And part of the general reps that we're talking about here are your traditional general reps. You'll see in the market now, and this goes back to sort of the reps that aren't covered, you're usually not going to get coverage for any COVID related, PPP loan related, CARES Act related, full disclosure reps, you know, your sort of 10b5 type reps, accounts receivable. So there's a collectability. There's certain reps that you can get coverage for, but an insurer will put sort of certain limitations on the scope of the coverage that you can get for that. But generally, this slide is meant to show you that for fundamental and tax, you'll get coverage for 6 years, and general reps is 3. The market is still pretty responsive to or working under an assumption that there's usually 10% of the enterprise value is what your policy limit will go to. Having said that, the insurers can select a preferred policy limit. It doesn't necessarily have to be 10%. And you can purchase limits in excess of that 10%. You can have limits that are applicable to only the fundamentals or only the tax representations. So again, this slide is meant to give you sort of what the typical structure of a purchase a policy looks like, but some of these things can change. And that one-time premium for higher limits, you might get a lower rate on the premium. We spoke earlier about underwriting fees. These underwriting fees are the fees that all insurance carriers will charge, and that fee is really what we like to call a diligence fee. It's the fee that they need to pay their outside counsel for stepping in, sitting in on those underwriting calls, asking very tailored, specific questions. You have to assume that those outside counsel folks have read all of the diligence material. So that underwriting fee is really to pay their outside counsel to participate in the diligence portion of obtaining the policy. And then, of course, last but not least, surplus taxes. That's usually somewhere between 1% to 6% of the premium, but it's based on where the named insured, so the entity that's going to be the primary insured under the policy, it's where they're located. And I think, David, that it's completely jurisdictional driven, right? It has nothing to do outside of how much, you know, limits you're getting or anything along those lines. It's jurisdictionally based on the amounts of the premium. The retention is usually still about 1% of the enterprise value, but as I mentioned earlier, it can be as little, I've seen as little as 0.65, depending on how large the deal is. And normally nowadays, retentions will drop down to about half of that percentage at the 12-month mark. The 12-month anniversary of closing, I think it's becoming a market standard now that retentions drop after that 12 months. Did I leave anything out, David or Joe?
Yeah, I was just going to say, in terms of premium pricing, you know, we got 2.8 to 4.2. 12 to 18 months ago, I think we would have said that might have been the 2 to 3% range. Is that right? So the market has hardened along with COVID, along with, you know, claims, which we're going to get into. We are seeing more and more claims being, I guess, noticed as well as paid out. To Mark's question, we'll get to that. So
Yeah, that's exactly right. And so those premiums have now gone up. Those premium costs have gone up because of, again, the ubiquitous nature of this product. The more you use, the more claims you're going to get. And you have market leaders such as AIG, who puts out a very robust claim study every year, and you get a real sense of sort of where the claims are being made, how they're being paid out. And as a market driver, you have your AIGs, your Euclids, your Chubbs of the world, who sort of drive where the rest of the market is going to respond to. And so in the last 12 months, AIG increased their premium, and very shortly thereafter, you saw that premiums just across the board have been increasing.
So we've got a polling question, and we're going to have, I think, another 3 or 4 more in the next 10 minutes. I think that we're kind of backloaded. With respect to M&A activity in 20 and 21 and 22, I expect deal flow will give everybody a few seconds to answer that. All right, Nancy, I think we could probably pull the results. All right. So it seems like people are optimistic, at least for the short term, but maybe not so much longer term beyond next year. Seems like a common theme to me. Every year, everybody feels good about the next year or two, but then don't know beyond that. So interesting perspective. Who are the insurers? Nia, indicated previously we're at kind of 20 to 25 primary underwriters with approximately $1.5 billion in aggregate capacity. A lot of the carriers, common carriers, are listed on this slide. Another polling question. So if you were paying attention about 5 seconds ago, this is just to see who's actually listening versus multitasking. So I think everybody in the Zoom environment we're living in is getting used to it a little bit here.
One thing I'd like to mention about the insurance carriers, and I welcome David's input here too, is that although there are 20 to 25, it's still very much, in my opinion, I guess I gave the answer at the same time. It's still very much sort of deal specific and insurance carrier driven in terms of what type of deal you'll take to a carrier. So, it's not always a guarantee that you're going to take the same deal to an AIG that you would to sort of a Vail, or Hamilton is one of the newer entrants into the market, just coming on the scene last fall. But I think it's important to recognize that just because you sort of go to the market, it's appetite driven. Not every insurer will quote for every deal.
I think we're down to 6 or 7 minutes. So I want to make sure we get through everything. Are there any highlights on this, Nia, that you want to cover before we jump to the last couple slides?
No, not necessarily. I think the slides sort of, and the participants will get this slide, so it speaks for themselves. I mean, we're going to see that the most typical claims are usually on the fundamental reps, right? With finance, tax, oftentimes material contracts. The claims process is meant to be easier in terms of execution in a rep and warranty policy than it is on the traditional deal. You want to get an insurer involved very, very early. So to the extent that you think that you have a possible claim under a policy, do a little bit of diligence, find what you can, but make sure, because there's a notice requirement in terms of when you can make that claim under the policy. And so as and when you become aware of something, and there's defined terms that I won't get into, but there's actual knowledge, there's specified people under the policy who, once you learn of a possible breach or possible loss, you have to report that loss and go through the claims process. And great brokers like Atlantic and others will help with that process. But it's very important that as soon as you become aware of a possible claim that should be made, that you get the seller involved to the extent that's necessary and it's prescribed as such under the policy, under the purchase agreement, but also make sure that the insurer is being provided with several all the documentation and all the information that you need, because I've seen claims, the claims process, now not even just a dispute or anything, but just the claims process itself that can run up to 12 to 18 months, because insurers will have follow-up questions. They'll want to understand, why is this a claim? They'll want to understand whether or not there's been any information with the sellers. They'll want to understand, to the extent that there was a special indemnity for a particular claim, whether or not, the policy is even responsive to such a claim. And then there's different types of resolution, right? Sometimes an insurer, and I've seen this happen, an insurer will say right off the bat, yep, this is clearly a breach of the material contracts rep. And, we're not really going to put you through the rigmarole of going through a robust back and forth. Here, that's what we've seen in sort of the informal results of claims process, and it can be as quick as that. But
and I don't want to cut you off, Nancy. Can you pop up the next polling question? And then Nia and David, let's stay on the theme of claims while people answer this question. Mark's question specifically was, can you discuss claim payments? How much of a fight is it with the insurance company? How often are they paid? And, it seems like there's so many exclusions on the policy that, maybe the insurance carriers are the ones that are coming ahead on this kind of a thing. So we'll give everybody maybe 5 seconds to finish the polling question. And then we'll jump into Mark's question. And this was a little bit of a trick question, actually. I think the market, broadly speaking, would say 1 out of 5 policies has a claim. I know, David, your experience is 1 out of 8 of your firm's policies has a claim, which probably speaks to a little bit more about how deep you go and how you work with the insurers to make sure they understand and the insured understands what they're getting into. Okay, now, David, do you want to maybe handle Mark's question about how often are claims paid in conjunction with the slide? And I think we've got 3 minutes left before we have to end on a polling question.
Sure. So I think from our perspective, 91% of the claims that we've had have been successfully paid out, and that's across the Atlantic in the US and our partner firm in Europe. So we've got a really strong track record of seeing claims paid, and have had really positive experiences for clients. As Joe said, 1 in 8 of our policies has claims. Financial statements, material contracts, and compliance with laws are the most common in our policies. As you can see, AIGs include tax, but for us it's been more along the lines of material contracts and compliance with laws. Very recently worked on a claim for a client who, sadly, 2 weeks after buying the business, found out that their their largest customer had given notice of termination under one of its contracts, and that hadn't been disclosed to our client, the buyer. It was a $2 million per annum, contract in terms of revenue to the company, and it was a couple of $100 million business. And on that deal, the process that we went through, it's a fairly involved process. Much like claiming from a seller, you've still got to demonstrate that you've suffered loss and that there is a breach. So it's fairly intense in terms of information gathering. You've got to prove breach, and then you've got to prove that loss flows from the breach, and then you've got to quantify loss. In our policy wordings that we do with Nia, we've got kind of best-in-class wordings collectively between the two of us and precedents with all of the insurers. And within those precedents, there are provisions that help clients bring claims and have costs or elements of bringing a claim paid for by the insurer. So this concept of prosecution costs, which helps clients to investigate, whether a breach has occurred, and helps them put together, the damages and the impact that breach has had on the business. On the, material contracts often go to EBITDA. EBITDA is often used, as to value businesses, and oftentimes as a multiple applied to recent EBITDA to value the company itself. On that deal, the $2 million contract that our clients $500,000 from the insurance carrier successfully. The process took around 9 months from start to finish. That involved litigators, it involved forensic accountants, it involved a lot of back and forth with the insurer to get them up to speed and to agree ultimately to pay out that claim.
I think the one thing I would add is that in terms of where the market is in terms of being responsive, right? There's so many carriers in this space and people want to be responsive to claims. The fight of, 10 years or many years ago that you had with some of the carriers, I have to say that I've seen there be a little bit more ease. So to Mark's question, yeah, it's 100% true that it used to be viewed as harder to recover on a claim under a policy, but with AIG's claims report and a lot of other carriers willing to share and brokers willing to share that information, I think that it's changing quite a bit.
Yeah, Euclid, who's one of the main carriers in the space, confirmed to me last week that they've paid out over 250 million. So, that's a huge amount of money. Huge amount of money. So, yeah, I'm pretty confident to say that our clients are making claims and that they are recovering. One of the most famous ones in the market is, at least publicly available, is the Novalex case. This is a Carlisle portfolio company. They are suing some of the insurance companies in the tower, not all of them. And that's a $267 million claim in just one claim itself. So my experience of the US market relative to Europe has been that claims are fewer in the US, but tend to be in larger quantums, whereas in Europe, there are a higher number of claims, the amounts just below.
All right. Sounds like this was a good topic. We ran out of time and we're at the 12:45 mark. So thank you again, Nia and David, and for FEI for hosting this. Thanks for all the participants. You've got our contact information in the deck. So if you have any other questions, certainly don't reach out to any of us. Thanks again for everybody. Have a great afternoon.
Thanks.
Thanks all.
We wish you the best of the afternoon. This does end our webinar presentation. CPE credits will be available in 7 to 10 business days as usual. Thank you.